Hi everyone, welcome back to our video series titled Investing 101 with Dr. Peng. Join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, great to have you back.
Hello, great to be back.
Yeah. So in this 5-part series, Dr. Peng and I will be talking about important investing concepts, namely inflation, equity, bonds, gold, and expected returns. In the first episode, we talked about inflation and its impact on society. The second episode, we talked about investing in equities. And in our previous episode, we talked about bonds. So today's episode will be about investing in gold.
Yes.
Right. So Dr. Peng, why do people invest in gold? I mean, every time we have our annual client events, we always have questions about gold. Yeah. So why do people want to own gold?
So from an individual investor's perspective, gold has long been the hard currency people use even in ancient days, right? And gold also symbolized wealth, stableness, and so forth. So it's not surprised that individual investors want to invest in gold and own gold, right? We probably see movies, right? People have stash of gold bars in their home and so forth. So today I'm very glad we're going to talk a little bit about long-term investing in gold. What's the risk and return, and how should investor today, looking at gold as part of their portfolio?
Right. So when people say they're investing in gold, do they actually buy the physical gold? How do they access?
So there are actually two ways to do that, and you're absolutely right. One way is to buy these physical golds in terms of gold coins or gold bars or even jewelry in some degree, and then leave it at home or put it into the deposit box in a bank and so forth. So that's called a physical gold. But of course, these days, there's an easier way to own gold. So there are, for example, for individual investors today, you can buy gold ETFs, where the amount of money you invest into the gold ETF directly corresponds to how much gold the ETF owns and stored it on behalf of you somewhere else.
Right. So where is this demand from gold coming from? I mean, of course, there are individual investors
Right.
who are purchasing gold, but is that all the people that are investing in gold?
Right. So in terms of gold, if you look at global gold and what's impacting gold's price increase or decrease, and that's essentially the return and risk of gold. It's basically the price goes up and down. So if you look at that from a supply side, the supply of gold comes from two places. One is new mining, right? The gold mines, let's say in South Africa, and then you refine the rock, right? And then you produce new gold. So that's about 80% of the supply globally coming from the new. And then the other 20% is, we call it recycled gold. It's basically, let's say, if I don't want to wear this gold jewelry anymore, I sell it back to the shop and they melt it, or recycled in the industrial component, particularly electronic component, there are a certain amount of gold. That counts about 20%. So that's the sort of the supply. And you can see the supply side is relatively fixed in the short term. To increase production, to increase refinery, it takes time. So that's sort of the supply side. If you look at on the demand side of the gold, there's really 4 type of parties that buy gold. We talked a little bit about individual investing. That counts about 20%.
Oh, only 20%.
Of the overall gold demand. The biggest one is actually jewelry. So here, we're separating people buying gold for jewelry versus people buying for investment purposes. So jewelry counts about half the overall global gold consumption. So half. And then the other roughly 10% is industrial usage, because gold has certain desired conductivity and whatever. And then the other remainder 15 to 20% is actually central bank. So global central banks buying gold as part of their reserves. So these are the four parties.
Right. So why do central banks want to buy gold?
So we talked about the supply and the demand, and we talked about supply coming from two sources relatively fixed, and then the demand coming from four different parties. So the dynamic of supply and demand really drives the gold price up and down. So when there's more demand, price go up. When there's more supply than demand, then the price goes down. So why does central bank want to buy gold? It's really because, like we talked about, even in the ancient times, gold as a way of storage of wealth. So when central bank have a lot of reserves, one of the ways to back up that, to invest in the reserve, is to own golds. And even 100 years ago, that's the primary way to keep the reserves. Nowadays, many banks use U.S. dollar, euros, Japanese yen, or even RMB to as a storage of the reserve. But gold is still one of the means to do that.
Right. In the previous episodes, we talked about equities, right, and bonds, right?
Yes.
So if you think about equities, we are essentially shareholders. We have a share in profits, and we
That's
actually have contribute to there's an economic theory to it, right?
That's
so
right.
Same as bonds, right? So as bonds,
You're
bondholders,
providing capital
yes,
to the companies or the government to do something to generate more economic outputs.
Yeah. So but when we talk about gold, you mentioned that industrial use is 10%.
Yeah.
Right. And
actually, a little bit less than 10%. I just rounded up to 10.
Right. Yeah. Right. And half of it is like jewelry,
That's
and,
right.
and all that. So when you think about it, they don't really have much economic drivers to it. So what? And essentially, you can say some may argue that gold is just like a shiny object.
Yeah.
Right? Just a shiny object.
That's true. So you're right. So gold, in terms of participating in economic activity and producing economic output, is relatively low. So when you look at gold, it's basically a storage or wealth, storage of money, so over time, gold price doesn't, over a long period of time, we're talking about, it doesn't really go up much higher than inflation. So it's moves around long-term average around the inflation, and with a decent amount of volatility. So from a pure investment perspective, gold is not a great investment. So we never want to use gold as the primary asset class when we look at long-term investing.
Right. We see the price of gold spiked up recently.
Yes.
So I'm quite surprised that you said in the long run it hardly keeps up or beats inflation, because there's an argument that gold is an inflation hedge. Yeah. So why do people think that? Like why is the price of gold going up in recent times?
So so we talk about gold. People sometimes talk about gold as a inflation hedge. I want to say yes, it's probably a better inflation hedge than some of the other asset classes, but it's a very weak inflation hedge. What gold really does well is during stress times. So you can imagine gold is a universally accepted hard currency, right? Tested through all period of time in many countries, all accept gold as the hard currency. So in stress period of time, for example, during wars and during extreme risky scenarios, gold has a lot more value because it's unique characteristics. So in that sense, if you look at why the last couple of years gold price has actually went up compared to what it has been, is precisely because of the increase of geopolitical tension and things like that. So for example, we talked about right now about 20% of the global gold demand came from central banks around the globe. Now, this figure used to be less than 10%. So the global central banks the last few years has increased the amount of gold on their books to replace some of the other paper currencies. Now, to give you a quick example, for example, Russia and Ukraine started a big conflict 2.5 years ago. And as a part of the consequence, Russians' foreign reserves were frozen by some of the Western countries. And so you can imagine in this kind of scenario, and having gold is much more advantageous for Russian than for having the reserves into US dollars or euros. So when there's increase of these attention, these geopolitical tension, central banks tend to want to hold more of these universally accepted hard currency as to paper currencies and so forth. And so you can see an increase in that demand essentially.
Right. When we talk about gold, we certainly cannot not talk about the US dollar, right? So in the past, the US dollar is pegged to the price of gold, right? It's linked.
Before 1972,
Yeah. And after in the 1970s, it got depegged, and essentially we get what we call fiat currencies, right?
Correct.
Currencies that are backed solely on the faith of the government rather than it being tied to gold.
Right. So after the Second World War, there is a period of time, from roughly, the late 1940s to early 70s, you can exchange 35 US dollar to 1 ounce of gold. And so that was guaranteed by the US Central Bank, or the US Federal Reserve for that period of time.
Right. So then is there an argument for gold being hedged against central bank failures, for example? Because right now the US dollar is the world's reserve currency, and that is backed by in people's
full
faith
credit of the US
government. Right. So would you think that some investors invest in gold because they are worried that central banks might collapse?
That's correct. So some investors are worried, particularly like I just mentioned, given the example of geopolitical tension and adversaries, where there's sanctions and so forth, you essentially not only facing depreciation of these paper currency, your entire reserve or asset can be frozen. So having reserves in your own control in the hard currency where it's universally accepted is much more preferred for some of these government. And so that's sort of the demand in that regard. And these days, there's no paper currency is pegged to the gold anymore. And because these governments just cannot afford to do that, and because of the amount of inflation and risk in doing that. So in a sense, gold provide a unique role relatively to these fiat money and paper currencies in the reserve setting.
Right. I'm going to put you on the spot here. I'm going to ask,
Sure.
I think maybe it's a bit more difficult kind of question. So let's say some people view gold as a store of value.
Yes.
Right? Some see it as a medium of exchange.
Yes.
But in my opinion, it can't be both. So why? If let's say it's a medium of exchange,
Yes.
but it is not inflationary, meaning it is a store of value, means you expect it to at least maintain its value, right?
Roughly.
So wouldn't it will cause the economy to kind of get into a standstill, right? I mean, if let's say I can buy a car next year at a cheaper price, I would just my propensity to spend would not be there. So I mean that's why for most central banks, they want to keep inflation rate there, just at a manageable amount.
at a low but positive amount.
Right. Yeah. So how do you view personally? How do you view gold? Is it do you view it as a store of value or a medium of exchange?
So these days, gold is more of a storage of wealth and storage of value, as opposed to a medium exchange, because it's so difficult, or the other means of exchange is so much easier than using gold, right? You never seen people carry a gold bar and come out and say, okay, let's figure out how much I need to
It's going to
pay.
be quite hard to give small
with
change.
the weight yeah. So I think it's mostly for the storage value, and in the emergent situation, you can convert gold into these fiat money or other form of media of exchange.
Okay, so as you know, at Providend, we don't have gold in our portfolios. So maybe you can explain to our listeners why, even though, as we discussed, there are certain benefits, but there are also certain downsides, and there are certainly uses for gold. But why don't we have it in our portfolios, for example, as an inflation hedge?
Right. So, there are other ways of hedging inflation. Like I mentioned, gold does provide a bit of hedge, but it's a weak form of hedge. So there's other ways in our portfolio that we can build together that does a decent job against inflation. And let's not forget that, we do want to make sure that the portfolio do well against inflation, but that's not the only goal, right? If we only worry about inflation, then we don't really need to invest in stocks or many other asset classes. So inflation to me is important, but it's not the top goal for any long-term portfolio. So I think that's something we need to keep in mind. Now, in terms of investing in gold, there are other aspects that we need to be very much aware of. One is, I mentioned, if you invest in physical gold, then there's storage costs, trading costs, all of that. Fortunately, there are other forms of investing into gold like ETFs. But if we take a step back, look at the long-term investment characteristics and the portfolio, and even to deal with long-term inflation or stressed, risky situations, Singapore being a very well-run and very disciplined fiscal policy and also high quality credit quality country. So essentially, the amount of risk you're facing is less compared to, let's say, if we are living in in a stressed geopolitical situation such as Ukraine or such as the Mideast. So the need for someone in Singapore to put a lot of money into gold is less there, because gold, like we talked about, it doesn't really produce a lot of returns over a long period of time, but do brings a lot of volatility. And so it's not as efficient as a long-term return driver. So that's sort of my perspective when I look at gold and how I would want to invest in long-term or not. So if I'm really, really worried about the stressful geopolitical tension, then maybe I will invest in a small amount into gold as a bit of hedge.
Right. So thanks for providing the context. I mean, in the context of Singapore, our currency is stable.
That's right.
Our fiscal policy is stable. So it's not really something that we should be too concerned about. But let's say I'm Argentinian, for example, perhaps maybe the argument is stronger own
That's
gold.
Right.
But okay, so let's say we're someone we're from Singapore, right, and we still want to have some position in gold, right? So roughly how much do you think we should have in our portfolio?
It's always hard to say. I mean, because it depends on the individual situation, all of that. So for a Singapore-based investor, if the majority of asset is in Singapore and so on and so forth, then I would say no more than 5%.
Right. Okay,
now,
thank you. Sorry?
This excludes, the jewelries you're buying or the other form of gold. I wouldn't call those investment, right?
Like wedding gifts, right? I'll
Yeah,
say,
wedding gifts.
My financial advisor told me I can't spend so much on gold, so I'm gonna give you less gold.
Yes. So exclude the jewelries and all the other things just for long-term investment purposes. I would say, no more than 5%.
Right. Okay, thank you so much, Dr. Peng. So that's all for this week's episode, and once again, thank you for your time and insights today.
No, thanks. I really enjoyed talking about gold today.
Yeah, me too. So to all our listeners, we hope that you found this session useful in understanding what it means to invest in gold and essentially what are the benefits and drawbacks to think about when investing in gold. So if you like this episode, please subscribe to our channel so that you don't miss out on the next episode where we will be talking about expected returns. So as always, thank you for watching and listening, and I'll see you in the next episode.
Thank you.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.